already, and I'm connecting him after. I'm talking to him after a break, so it's always good to talk to Saurabh. Saurabh, good morning. Thank you for joining us. What should we start with? We're not starting with Asian Paints or HDFC Bank or Kotak. We'll have to start with something different.
Okay. Now we can start with, I spent 2 weeks in America meeting institutional investors. If you want, I can give you a sense of why they are getting ready to load up further on India.
Are they getting ready to load up to India? And if yes, why? And what was the broader theme which you, in a sense, argued when you met them?
Look, what we were surprised by is the degree of despondency vis-a-vis China. So I have to confess, I've never been to China. I've been to Hong Kong several times, but I've never been to mainland China proper. And like everybody else, I just read the newspapers about what's happening in that vast country. But meeting the endowments and the pension funds in America, it is pretty clear that they've got fairly dire news flow coming out of China. The rolling COVID lockdowns, which are going to hit their third anniversary soon, are having a real impact on people's morale, on the economy, on the production facilities that Western companies have there. And more specifically, the new Chinese Politburo that has been created, that's created real alarm in the Western world. Given that Western investors have $3.5 trillion invested in China, the sense I got from our meetings is a substantial amount of that is going to leave that country. And even if out of that $3.5 trillion, even if $500 billion comes to India, that will virtually double the FII investments in our country. So obviously we as Marcellus are trying our best to see if we can bring some of that $500 billion to the Indian stock market. But leaving Marcellus aside, I think the broader story of India over the next couple of years will be very significant FII inflows. They've already begun, but I think these FII inflows will step up over the next couple of years as China continues to unravel.
Saurabh, tempted to ask, where is that money going to find its way? And I just wanted to probe a little bit about the China plus one advantage that India is currently seeing, and manufacturing seems like, the big beneficiary of the same. Is that a pocket of interest for all the investors that you met overseas?
Yeah, I think the three sectors that there is a lot of interest. Remember, we are talking to these are pension funds and endowments, so they're basically talking to people like us to leave it to us to decide what to buy. But basis what these endowments and pension funds are reading in the Financial Times or the Economist, they're very keen to understand three sectors. Firstly, the fact that the iPhone 14 is being made in India and that Foxconn is having trouble making iPhone 14 in China, that's got people really intrigued. So basis what I know, roughly $1 billion worth of iPhone 14 is being exported out of India every month. Apple has also announced that AirPods are going to be made in India. And therefore, the broader question that a lot of people are asking is, how big can the smartphone opportunity be for India? On some estimates that we've seen, the whole smartphone and the supply chain feeding into smartphone can be as big as the auto sector in India. So there's a lot of curiosity about that as to how can one make money from that. The second area is a sector we've all discussed on your channel for a couple of years now, which is this whole API market. The global API market is around $250 billion. China accounts for around $200 billion of that. It's relatively clear that the US government is quite uncomfortable with that. And the question, therefore, we got asked was, how materially can India capitalize on the API market? Can this become a $100 billion sector for India? And if so, which companies can benefit from that? And we'll discuss that on your channel for a couple of years. And the third is defense. We import $70 billion of defense equipment every year. And as you would have seen from the Airbus Tata deal, it looks likely that there will be more of these deals where a foreign defense company, whether it's a Lockheed Martin or a Raytheon, they do a JV with an Indian partner, and that $70 billion going out becomes part of the Indian economy. So if you add these three up, right, you're looking at least $500 billion of extra economic activity, which for a country like ours with a $3.5 trillion economy, $500 billion is very meaningful. So lots happening in the background, which is also leading to the buzz around India. And there's obviously a whole bunch of things, unfortunate things happening in China, which is leading to Western despondency about China.
A lot has changed in last 1 year, and a lot will perhaps change in next 1 year, whether it is geopolitics, interest rates, commodity pricing, or India positioning. When things change so dramatically, what changes for the companies you track? What changes for your portfolio positioning?
So one of the things I've seen in my career, and I've been doing this for the best part of 2 decades, what I've seen in my career is when the world changes quickly, when there is flux, there is a rising cost of capital. You have to go with the highest quality management teams, right? So you have to back the champion capital allocators, promoters who have proven themselves decade in, decade out, that they can run high quality businesses regardless of whether GFC is happening, COVID is happening, China is booming or China is going down. And I think that remains the Marcellus call. We obviously discuss these changes to death internally, but ultimately the call remains, let's back promoters who've proven themselves time after time that they are champion business operators. And therefore the core of the Marcellus portfolio is not going to radically change, even if China crumples over the next 2-3 years.
Will Saurabh Mukherjea ever sell Asian Paints or HDFC Bank?
So we continue being large holders in TCS. We continue to believe, as I've said for the last 6 months, that a huge part of the Western IT opportunity is yet to come to India. We're only at one-third of the way. We're one-third of the way through the IT journey. In a sort of subset of that opportunity, L&T technology services and engineering R&D, again, basis what I heard in the West, as Western companies struggle to find science, technology, talent, engineering R&D seems to be a natural industry for India to ramp up in. Think of engineering R&D as the IT services sector, but with a 10-year lag, where IT was a decade or so back, engineering R&D is today, and therefore I believe there's a very bright future for firms like L&T Technology Services. In the specialty chemicals and pharma space, we've discussed on your channel that entire value chain, starting with DVs and API, firms like alkylamines and intermediates, and GMM Pfaudler in creating in manufacturing the glass line reactors. We continue ramping up on all of these stocks. I've been pleasantly surprised by how kind the market has been to us on DV's lab. We're continuing to bulk up on DV's. We believe it's a company ideally placed to capitalize on the opportunities that the changing geopolitics is presenting. Just a quick disclaimer, my parents, myself, our 10,000 clients have exposure to all of these names that I just spoke about.
Sort of willing to change your opinion on Reliance yet or no? Because you've been off it for, I think, over a year now, haven't you?
So we continue to be impressed by how they are executing on the telecom opportunity. Remember, till 5-6 years ago, this wasn't really a telecom company. So remarkable to see in the space of 5-6 years a giant telecom business being built. But it's free cash flows that we look for, and whilst the free cash flows remain elusive, we'll keep tracking the stock without actually investing there.
Good morning, Saurabh. Nayantara joining in on the conversation. I want to ask you about one of the stocks you do own, which is Relaxo, and the numbers that we've seen the stock market is also punishing Relaxo, 67% drop in the profit. What's your strategy? Will you continue to hold on to it long term? What's the outlook?
So I think we are very pleased about the price cut. So we've actually met Ramesh Duaji earlier in the quarter, and we made it very, very clear that we wanted to see Relaxo more aggressive on pricing. We want to see our investee companies, not just Relaxo, we want to see all our investee companies absolutely crush the competition. And our point remains to all our investee companies that when input prices go up, right? When input prices go up, you as a Marcellus investee company should cut prices so that the competition gets wiped off the table. So we are very pleased to see what Relaxo has done. And we don't mind taking few quarters of profit margin drops and EPS going backwards, right? The skill of a smart promoter, and Ramesh was an extremely smart promoter. The skill of an extremely smart promoter is to use opportunities such as the ones presented over the last 9-10 months of rising input costs. Use this to pressurize the competition and get competition to shut shop. So delighted to see what Relaxo has done over the past quarter, and hoping to see further consolidation in the footwear industry. Remember, footwear remains an industry where I would say 60-70% is still informal. We need to see those informal guys getting compressed, getting pushed up, so that investee companies like Relaxo prosper.
Saurabh, did you use the recent sell-off in the new age companies? We saw what happened to Nykaa, less than 1,000 rupees. Delivery also crashed a lot. Policy Bazaar. Did you use any of those to stack up on new age companies? Can these be your champions?
So we remain on the lookout for new age companies who actually are building a real business. I think Nykaa does fall in that category. So kudos to the team there for focusing on operating profits, on cash flows. It's difficult to find too many new age companies like that. So whilst we'll continue to monitor Nykaa, I'm not so sure too many other new age companies actually are worth monitoring. Most of these business models, to our mind, are not actually business models at all. They're fundraising models, and hence we will stay. We'll keep away from them. But yeah, we'll continue monitoring Nykaa to see how that franchise shapes up. If you look at venture capital the world over, not just in India, venture capital or new age companies the world over, the attrition rate, the survivor rate tends to be quite low. The survivor rate tends to be quite low, and I think India will see the same as the cost of capital carries on rising globally, as the funding winter for new age companies continues. I think we will see a lot of consolidation, a big clean out there, and we're on the lookout for our investee companies capitalizing on that. We're on the lookout for Marcellus investee companies pushing into the spaces where American venture capital or SoftBank money or Alibaba money had hitherto funded Indian ventures.
Right. Saurabh, last 2 years, the economy has enjoyed a certain degree of revenge shopping and a comeback post the lockdown. Now that interest rates have moved higher, now that the base effect would kick in, is there a risk consumption in next 12 to 18 months? And the reason I'm asking you this is because if there could be a inflationary infused slowdown, it could impact Titan, it could impact Asian Paints, it could impact Relaxo, it could invest some of your large companies where you invested in.
So we have a consumption concern, but it's a little different from what you're articulating. So we are not concerned about, say, middle class or affluent consumption, right? So, will Royal Enfield carry on growing rapidly? Yes, I think it will. So will Maruti, so will our investee companies, because job creation, formal sector job creation in India is running at a rapid rate, and from everything we are seeing, pay rises, pay hikes are also growing at a rapid rate. So middle class India is sort of blossoming and booming, and I think that story will continue. Where our concerns are getting exacerbated by the passing quarter is low income consumption, because this entire global inflationary surge is punishing low income people even more. They got punished through demon and COVID, and now for low income people in India, this inflationary surge is a real, I think, killer, and you can see that in the weak results that the FMCG companies are producing. You can see that in the weak volume growth that the two-wheeler manufacturers are producing. That's where I think we have a little bit of a challenge in India. It's obviously a challenge for our politicians as well. And it's a tough one. It's a tough one. Job creation for low-income people is tough in India, and on top of that, have inflation pounding these people's purchasing power. That's where we're a little concerned, which is why, just echoing the point I was making to Nayantara, delighted to see Relaxo going on the offensive, cutting prices and making I think that they'll make a real attempt to consolidate the low end of the footwear market.
You have remained quite bullish on select auto ancillary names, but said that Eicher was one of the only credible players in the premium market, and you're avoiding the likes of a Maruti as well as an M&M due to concerns on pricing power. Does that thesis still hold? And what's the outlook after having read into the kind of auto sales numbers? And what's the view on auto and auto anch?
So you're right. I mean, the cars market has come back nicely post-COVID, and super numbers from Maruti and M&M. The challenge in cars has been, if you look at the data for the last 20 years, it's a pretty, so it's a cycle with 4 or 5 years of decent volume growth, say 20%, 25% for 4 or 5 years, and then 3 or 4 years of utter famine. And it's very difficult for us to predict that, right? And if you take a cross cycle volume growth picture for any of the car manufacturers, you sort of end up with numbers around 10, 11, 12. which don't really move the needle for us or our clients. So cross cycle Indian auto tends to be a tough thing to buy. If you can time the cycle, which we can't, those who can time the cycle by all means enjoy the fruits of being invested in Maruti in the upcycle. And if you have the prescience to figure out when the volume cycle will conk off, get out of Maruti. Unfortunately, we don't have that sort of skill set.
Really appreciate your time. So glad you could join us, and so nice to hear the endorsement what the foreign institutional investors or some of your prospective clients and sharing with you when it comes to India narrative. I always say that now time has come. सारे जहाँ से अच्छा हिंदुस्तान हमारा, and I think it's getting more and more visible in the way how the world is now tilting towards India, whether it is in the manufacturing space, whether it's in the digital space, or whether it is moving capacities from China to India. Forget China to India. Now it's Europe plus one, which in a sense is also gaining a lot of steam. Markets, meanwhile, what